Okay, so we're going to go for about 57 minutes. I got this little thing here. And after that, we'll take questions, right?
Sounds good.
That'd be wonderful. And here we go. Hi, this is Alan Chartock with a special conversation here at the American Institute for Economic Research, AIER. Our special guest today is Professor Kathleen C. Engel, who will talk to us about the subprime crisis, where we are now. First, let me tell you a bit about our distinguished guest, and there's a lot to say. Professor Engel is the Associate Dean for Intellectual Life and Professor of Law at Suffolk Law School. She is a national authority on mortgage finance and regulations, subprime and predatory lending, and housing discrimination. Her many publications include a 2011 book published by Oxford University Press, The Subprime Virus, Reckless Credit, Regulatory Failure, and the Next Steps. That's with Professor Pat McCoy. And articles in the Harvard Business Law Review, forthcoming Texas Law Review, Fordham Law Review, Washington University Law Quarterly, the Journal of Economic and Business, Housing Policy Debate, and Harvard Journal of Law and Public Policy. Professor Engel presents her award-winning research in academic banking and policy forums throughout the country and around the world. Her analysis of financial service markets and the laws that regulate them regularly catches the attention of the press, the New York Times, Business Week, The Economist, ABA Journal, ABC News, The Wall Street Journal have all cited her work. Professor Engel has advised federal and state agencies on various matters relating to financing of loans and served for 3 years on the Consumer Advisory Council of the Federal Reserve Board. Professor Engel is an honors graduate from Smith College and the University of Texas School of Law. Following graduation from law school, Professor Engel clerked for Judge Homer Thornberry of the Fifth Circuit Court of Appeals in Austin, Texas. She then practiced law at Burnham and Hines in Boston, where she primarily represented plaintiffs in civil rights and housing and employment discrimination cases. Prior to joining the faculty at Suffolk University, Professor Engel held the Leon M. and Gloria Plevin Professorship at Cleveland Marshall College of Law. Professor Engel has taught courses on torts, civil procedure, employment law, employment discrimination, consumer credit, and the financial crisis. Professor Engel, welcome.
Thank you for having me.
So glad you're here. Let's start by asking you, if there's a single word that comes basic to this research about the subprime crisis, what would that word be?
I know that word. The word is hubris.
Why hubris and not greed?
Well, because I think greed is a piece of it, but it was also a naive belief that you could make bundles of money without thinking about the consequences of what you were doing. And that's why hubris captures greed and what was really going on.
Okay, so take us back to the beginning of the situation and tell us how it all unfolded.
Well, the beginning for me really was Cleveland, Ohio, because I was living in Cleveland, and Cleveland had been a very depressed city that was having a renaissance in the 90s, and it was very exciting. There have been great new developments downtown. The Cleveland Clinic and University Hospital and Case Western were all expanding. There was a big state university that was growing, and life was looking up for Cleveland. Nobody was singing songs about the river being on fire anymore. So, and then all of a sudden, you started to see foreclosures and people driving around in cars that said, turn your house into a loan with just those, stickers that they could peel off at night and things like that. And I started to wonder about these loans that were being made. I also lived in a racially diverse neighborhood. It was half African American, half white. And we were getting targeted every day with flyers to refinance our home. And we didn't just get flyers. They would knock on our doors, they would call us, my children would answer the phone and say, "We know you're a predatory lender." And it was really, and my co-author, Pat McCoy, is a single woman, and they knew that somehow these folks knew she was a single woman, and she was getting 3 times as many solicitations as I was getting. And every time in the community we lived in, there were a lot of housing code requirements. You couldn't change your shutters unless you went and, submitted colors and designs and all of that. And you always got cited. Every time there was an inspection, you got cited. And every house was inspected, every 3 or 4 years. So what would happen, as soon as you got your citation, the number of flyers would multiply exponentially. So I was trying to understand what's the deal with these loans? Why are these people coming in here? And at the same time, we were seeing foreclosures starting to mount. Why would people be making loans that borrowers couldn't afford to repay? It was a really simple question. I was just when you're an academic, you're really lucky. You have the privilege of being able to be intrigued by a question and then go off and see what you can figure out. So that's what we tried to do. And we just looked at every single actor who was involved in the process and tried to understand how the whole housing market had changed. So we looked at the roles of brokers, of appraisers, of lenders, of investment banks, of credit rating agencies, all the way to investors. So through that whole chain that a loan goes through, and saw where there were problems, how the market had changed to allow this type of lending to go on. So that was the very beginning. And then it spread. What was happening in Cleveland spread to other communities. And there were reasons why Cleveland was really the epicenter. One is that Cleveland is, or at least at that time, and I think is again now, Ohio is a state without much regulation. So the banks were not subject to any of the rules prohibiting unfair and deceptive acts and practices. And there was also a lot of pent-up demand for credit because of the history of race discrimination in Cleveland. So you had a lot of people who wanted to borrow money. Oftentimes they owned their homes outright. They had inherited their homes from parents, but they wanted to replace the roof and needed a loan to be able to do that. So the combination of a pent-up demand for credit, the lack of regulation, and the fact that a lot of people, particularly in the lower income communities, and particularly those communities that were predominantly African American, people did not trust banks for good reason. Right? For good reasons having to do with history. So instead of going to the local community bank that probably would have given them a decent deal, they were going to brokers who were in their communities, and they trusted the wrong people. So we had this whole kind of perfect storm in a way of forces coming to play. And then these people were taking out these loans and paying very, very high interest rates. The first stage of what I would call predatory lending, people were paying interest rates of like 18% when the market rate, based on their credit risk, would be about 7 or 8%. So the investors were willing to buy bonds that were backed by these loans because they were making unprecedented profits on bonds, right? You think of bonds as kind of the safe instruments unless you're buying junk, where they were making huge returns on them. And it's because the spread on these bonds between what people really should have been paying and what they were actually paying was so great. And during this period of time, it was not so much that people didn't, it was that people had the equity in their homes. They tended to have as much as 100% equity in their homes, but they were taking out loans based on the equity, not on their incomes. So the subprime crisis was actually the inverse of that. So just focusing at the beginning part, what would happen is somebody would take out a loan for $20,000. They wouldn't be able to they didn't have the income to support the monthly payments. So then the broker would, as soon as they defaulted or were about to default, the broker would come in and say, oh, here you go, I can take care of this for you, we'll just refinance. And then the broker would charge them $10,000, $15,000 in fees that would get tacked onto the loan. And it would keep going. And every time it was churned, the borrowers would lose more and more equity, and then there would be the foreclosure. So that was the first stage.
Now, why were they taking out these loans if they had 100% equity? Maybe a little bit of a naive question, but why were they doing that?
I think they were doing it for the same reasons a lot of us might take out a home equity loan. It would be cheaper than a car loan to buy a car, right? Maybe finance your child's education, maybe a sudden health problem, and they wanted to pay off a health bill. Some of them had gotten in trouble with credit cards, and they were convinced to, that consolidate your debt, take out a loan. And oftentimes it was home repairs. In fact, the people often at the very beginning of this whole subprime, epoch, the people were getting hit with housing code violations, that their porch was falling off or whatever. And so they would, and what would happen is those violations would get registered in City Hall. And within 48 hours of a violation being registered, it was in the public record. And the mortgage brokers would go to the town halls and city halls, and they would see what violations. The people felt like it was manna from heaven, right? I can't believe it. Just when I get this housing code violation, you show up on my door, and not only will you loan me the money, but you have a contractor who you trust who will come in and do the work. The worst example I saw during that period of time was somebody who got a job as a mortgage broker. And on his first day, they brought him in, and they had him take his picture with him with a disabled child. And then they had him take a picture with an elderly woman. And then they took a picture of him with a black woman and 2 biracial children. And then a picture of him alone with 2 children. And he had little biographies for each of these pictures. And every picture he got wallet size and also 8 by 10. And when he went to somebody's house, he figured what was the right persona for that consumer. And then when they came into his office to sign the papers, his secretary would tell him, okay, this is the 8 by 10 glossy you need to have on your desk.
Could you also explain to us the beginning of this idea of bonds? How did that work?
Okay, this is one of my favorite things to talk about because I think it's so interesting. I really didn't understand finance. I got into this field because I saw what was happening in these neighborhoods as a civil rights issue, and sometimes you have to learn other things to explore what interests you. So I really taught myself financial economics, and Walker probably knows a ton more than I do. But I relied on people like Walker and others to help me to understand a lot of the real estate finance. So essentially what happens, what has happened in the last 30 years is we have this process called securitization. And the effect of securitization is that it takes loans that used to be held in banks' portfolios and it turns them into an investment vehicle. And the reason this is important is that banks run out of money. They make their loans, and they eventually have made loans to many, many people, and they don't have any more money left to loan. And so you always have a queue of borrowers who want to get credit but can't. So one solution to that is to create a process where banks can sell the loans, can get them off their balance sheets so that more money comes back in and then they continue to loan money. There also is another challenge for banks, and it's part of what happened with the savings and loan crisis, which is that when banks make a loan, say for 30 years at current interest rates, 4%, 4.5%, when interest rates go up, they're really in trouble, right? Because they're getting paid at 4.5%, but they're having to pay depositors maybe at 6%. So, and also they have to they're constantly borrowing money, so they're borrowing money at a higher interest rate. So it's called, that they're lending long and borrowing short, and that creates various financial problems, and that's part of the reason we had the savings and loan crisis. So that was another problem that securitization needed to solve. So what securitization does is it takes a bunch of loans. They get sold, usually to what used to be known as an investment bank. So I'm going to call them investment banks now, just so you understand. And it goes to an investment bank, and investment banks create a pool. They put all the loans into one pool. And then they divide that pool, not by loans, but by risk. So in a really simple model, say you have you divide the pool into 3 groups, A, B, and C. And you sell bonds. So somebody can buy A bonds, somebody can buy B bonds, somebody can buy C bonds. Whoever owns the A bonds gets paid first. Whoever owns the B second, C third. So as borrowers pay their loans, the money goes into the pool, and say that Alan owns, the A tranche. It's not that my payment will go to Alan. It's that as the money is coming in, he will get paid off first from that entire pool. So whoever owns the A bonds has the less risky bond. Junk bonds are the ones that are right at the bottom. And whoever has the A bonds, they usually get paid. Not only do they get paid first, but the bonds mature first, And they also pay more money for the bonds. They're more expensive. So junk bonds are at the bottom. So what this meant is that you could take this pool of loans, you could offload them to investors through the bonds. The banks get the money to be able to make more loans, but also because people have different levels of risk tolerance, those of us who are more conservative would buy the A bonds and say, look, I'm willing to pay more to have less risk. And the people who are more risk-loving could take on more of the risk. So it actually really was a more efficient way of allocating the losses, potential losses, and the overall risk. The downside is that what you wanted me to go to? Yeah. The downside is nobody was minding the hen house. So you have the mortgage brokers. As soon as the loan goes through, they get paid a commission. They're on to the next loan. You have the lenders. As soon as that loan gets sold, they don't have any incentive or they have a reduced incentive to make sure it's a quality loan because it's not staying on their books. The investment banks, they're making money on volume, right? They need to keep those loans flowing through because they're getting all these underwriting fees and all sorts of stuff based on the dollar value of the loans they push through. So what do they want to do? They want loans that are for a lot of money, that have high interest rates, and they want a lot of them. And so they're saying to the lenders, give me more, give me more, give me more. And they're actually buying lenders. So one thing people don't know, for the most part, is that all the major investment banks owned a subprime lender. And that's how they were able to assure themselves of a steady supply of these loans. But they were also offloading the risk onto the investors, right? Now, everybody's at fault here. Nobody's innocent. Some borrowers are innocent. Some are definitely not only at fault but complicit. Investors are at fault too, because what did investors do? Instead of going and looking at what was in those pools and really getting some granular data and insisting on it, they just relied on the credit rating agencies, who gave their good housekeeping seal of approval on these securities. Now, why did the credit rating agencies do that? Because you eat what you kill. So it used to be that, in the old days, that the credit rating agencies were a subscription service. If you wanted to get a rating on a security, you bought a subscription from Moody's or Standard & Poor's or whatever, and every week you got your ratings. At some point, they switched the model, and instead of having it be a subscription service, they said, whoever securities we rate, they have to pay us. I always joke with my students, this would be like you coming in and saying, okay, I'll pay you, and I'll take a class from you again if you give me an A. That's exactly what it was like. Though my students always come back and say, well, that is kind of how it works. I mean, we do pay you to grade our work, but...
They also evaluate you.
That's true. That's true. So what happened is the credit rating agencies, if they said no, we're not going to give this a high rating, well, then that investment bank is going to go back to them again. They'll go to the credit rating agency that's going to give them the high grade. And there are even examples of the arrangers, the investment bank type entities, putting pressure on the credit rating agencies and saying, hey, we can go somewhere else. And if we don't get what you want, or going over the heads of the people who were giving the ratings and saying, I want something done about this rating. So you have all of these different entities. Oh, and then of course there's the federal government.
I was going to mention the politicians.
Yeah, right. So when this all began early on, Senator Graham, who was in a powerful position at the time, said, well, we can't regulate this abusive lending because nobody can give a definition of predatory lending. And that message carried through to the White House, and essentially the federal government put a hold on doing anything around this abusive lending. Alan Greenspan went, I can't remember the year now, but in early 90s, I think, Congress passed a law called the Home Ownership Equity Protection Act. So, 95, thank you. So when you'd think you were the lawyer. So when they passed this law, it says in the law, it said, the Federal Reserve Board of Governors shall issue rules protecting consumers from abuses. in mortgage lending. So it was shall. It was a mandate, not can. And Alan Greenspan, as a matter of policy, said, I will never issue regulations under that provision. And he never did. He never did. So while this whole crisis was building, there was nothing happening at the Federal Reserve. At the same time, the Federal Reserve had the power to regulate not only the lenders who are banks that were members of the Federal Reserve, but also all of the bank holding companies. So any big bank is part of a bank holding company, and the Federal Reserve Board had the authority to supervise and investigate the entire bank holding company as well as their subsidiaries, which would mean the subprime lenders that they owned. And Alan Greenspan said, I don't have the legal authority to do that. There was nothing in the law that said he didn't have the legal authority. And in fact, when Chairman Bernanke went into office, people started asking about it. And he couldn't very well just say, well, I guess he could have, but he chose not to say Greenspan was wrong. And instead he said, we're going to start a pilot program. But it was just window dressing in a way, or really just a segue to allow him to really do what the law gave the Fed the authority to do. So now, bank holding companies and their subsidiaries are subject to regular Fed supervision, but this was a change. So that's what was happening at the Federal Reserve. The FTC,
what happened at HUD?
Well,
wasn't there a governor who's in New York right now who was the head of HUD who wanted to get everybody into a house at the time?
Yeah, so there are a lot of debates about the push for housing. I would say it's not limited to just one person. It's not limited to one political party. It was Clinton, it was Bush, it was many of us, it was me. I think home ownership is an incredibly important tool to accumulating wealth. The problem was that the policy was just everybody should own a home. It wasn't everybody should be able to own a home in a sustainable manner. So people were getting into homes who really didn't know just the practicalities. Like, there are people in my family who shouldn't own a home. It doesn't matter how much money they have, right? But just, practically how you do it. They didn't understand the financing, and they couldn't afford it.
You were going to mention the FTC. I'm sorry, I got you off track.
Oh, that's okay. No, I like getting off track. So the FTC had jurisdiction over the non-bank lenders. So these are lenders who don't have deposit accounts, like Ameriquest is one that you've probably heard about, New Century. So these were entities that were not subject to bank regulation. And the FTC under Clinton, did some very, very good investigations of these really kind of fly-by-night operations and shut down some very important ones. But when Bush came into office, the FTC just shut down all of those operations. Now you may have seen that the FTC is up and running full steam ahead in going after some of these entities and has gotten some very big settlements out of the few that are still solvent. Also, the bank regulators played a role. When the federal government, when it was very clear that there was no way that the leadership in the Senate who wanted anti-predatory lending laws to go into effect would be able to get the votes, the states stepped into the void. And it began in North Carolina. And North Carolina passed a state anti-predatory lending law that had really, really far out, outrageous provisions in it, like you cannot make a loan to somebody who cannot afford to repay it. And the bank regulators on the national level went nuts. And they issued rules saying that no depository institution that had a national charter, so that's every big bank you can think of, has to abide by these state rules. And it went all the way up to the US Supreme Court, and the US Supreme Court said, yes, they have the power to do that. So the states, over half the states in the country, passed those laws, but they only applied to the little guys. They applied to the community banks, the neighborhood banks, not to the big national banks. So it created a really unequal playing field where, they were really having to function under a different set of laws. The big banks were not subject to the state laws, and there was no federal law, basically. And the smaller banks were subject to these state laws. And in states that didn't have the laws, those banks functioning there had an added advantage. They were like the big national banks, no restrictions.
So in the end, were not the smaller banks that had to abide by these rules, and didn't they have the last laugh? I mean, weren't they better off than if they had obligated themselves the way that the big banks did and gotten underwater?
I think yes and no. So if you look at the banks that have gone into FDIC receivership, very few banks are the small banks. So the whole regulatory scheme, bank regulation in the United States, is very, very fragmented. But the small state, what we call state chartered banks, they are regulated either by the FDIC or by the Federal Reserve. And if you look at, and I've done analysis of this, the number of banks that were regulated by the FDIC and the Federal Reserve that have gone into receivership, it's minuscule relative to the large banks, both in terms of absolute number of institutions and dollar amounts under in deposits. But that doesn't mean the small banks aren't in trouble. And the reason that there are pockets where the small banks are in very big trouble, Atlanta, really their small banks went bust, and they were doing risky commercial lending. It wasn't super risky, but it was somewhat risky, and that lending was for residential real estate development. So when everything crashed, they came down not because they were making bad subprime loans, but because the economic recession then brought them down.
Okay, so what were the consequences of all of this?
You don't know that? Well, the immediate consequences of the crisis were that we came within centimeters of people starving to death all around the world. I honestly believe that. When everyone developed a mistrust in these various instruments that were out there, and there were lots of really funky things happening, SIVs and SPVs and all these different things that I'm not going to go into, the ability of commercial entities to borrow money short-term, what's called the commercial paper market, ended. The commercial paper market in the world froze. And when that freezes, that means grain cannot get to Africa. It means medical supplies do not get to Bangladesh. And that's where we were at. The commercial paper markets froze. So there was about 36 hours there where I really thought we were at the brink of causing an international disaster.
Were you, Professor, watching this real time as it
Oh, absolutely.
Unfolded?
I didn't sleep for days, and I was on. Partially because reporters were calling, because there weren't that many people who had been doing work in this area up until that point, but also just watching things like the LIBOR, which is the rate at which banks loan money. In London banks loan money to each other, and that really that was moving all over the place, and something called the OIS spread. I was just watching these metrics constantly.
So the butterfly that originally flapped its wings was in Cleveland.
That's right. That and the big blackout both started in Cleveland.
Amazing. Okay, I'm sorry, go ahead.
Well, so that was that immediate thing. And we did, there are lots of ways in which I think Congress and the Fed made mistakes in the bailout. I would have gone for much more long-term cuts in executive compensation and things like that. But I really believe that Ben Bernanke saved the world. I mean, I really do. In those few days, his knowledge of the Depression and his wisdom.
He had written his PhD thesis on this, right?
Yeah, yes. Right. I thought it was great. I told him that a number of times, just how grateful I was. But there were a lot of problems too, so I'm not don't want to pretend I didn't oppose a lot of what they did. So then what happened is, we had the fallout in terms of foreclosures, defaults, but then we had what I think of as the more significant fallout, which is, just the economic collapse and what it meant for job loss, and the fact that we, for whatever reason, and maybe it's because there were so many people involved, maybe because our society and our economic functions have become so much more complicated, we just didn't get it together to come up with solutions. We just got stuck. And when I've talked to bankers about it, what happened? Why weren't you more aggressive when this was happening? And they said, the housing markets always recover. We figured 6 months' time it would recover. And that was naive, I think. I didn't see any signs that was going to happen. The foreclosure starts were going up and up every month.
Did you think there was any criminal action perpetrated here by any of the bankers?
It'd be easier if you asked me any of the brokers.
Any of the brokers?
Yes, but I think it's going to take a very long time before we get the dirt. And the reason is that the people who probably, know what really happened and turned a blind eye have made huge amounts of money. And they have signed non-compete agreements and non-disclosure agreements. And they're not going to talk, because even though you do have to disclose information if you're subpoenaed, even if you do have a confidentiality agreement, they are not going to want to do that voluntarily. And they'll get sued by the big banks, and they have a lot to lose if they come clean. So the only way we're going to get to that, I think, is by getting people at the bottom, getting them to talk. My supervisor told me to do this, and then it slowly works its way up. But at this point, people have no incentive to come out now and talk. And in fact, the people who have talked are almost all mid-level employees who got fired. And then they're suing for wrongful termination. And in the course of that litigation, they say, we were terminated because we complained about the fraud. The other thing is there's this, not sure the right word to use, but there are ways that the industry put up firewalls so that they wouldn't know. But it's a little bit like my saying, I didn't know my kids came home after having been drinking because I told them they could go straight to bed when they got home, right? And they didn't have to come in and give me a kiss goodnight so I could do my own little breathalyzer. It's kind of like that. They set up structures where they could willfully not have the knowledge. And that's not necessarily fraud. So it's going to take really good lawyers to get them.
Wow. There's a lot of anger in this country about how the bankers and the brokers got away with it. Is that justified?
Yes. Yes, it is.
But it doesn't seem to have political consequences.
That's right, because we have about 6 banks in this country that we all need, and that are really, the drivers in the economy right now, or at least they're the machines of the economy right now. And I think that their solvency is uncertain. Maybe people have other opinions. I don't know what yours is about that. But until those banks get solvent, we need them. And once they're solvent, then we can figure out what to do with them. But I think that's a piece of it. And that's why politicians are not sort of getting on the horn and enough and calling them out, other than Elizabeth Warren.
I take it you're talking about too big to fail?
Yes, talking about too big to fail and plain old too big. We're look at what's happening right now with Jamie Dimon, and people
He got applauded at the Senate the other day.
Right.
$2 billion, mess. If you were a king or queen, or emperor, what would you do right now?
Yeah, that's a good question. Well, I guess one of the first things that I would do is I would cram down all the mortgages. I think that one of the things that we need to do right now is stabilize the housing market. My feeling is that in this country, other than the drive for home ownership, people have disregarded how important the housing market is to the wealth of the country. People think of the stock market. They think of corporate profits and strength. They think of innovation. But the housing markets are incredibly important. And right now, they're stalled. And we have a lot of people who are underwater in their homes. They want to sell their homes, and they can't because they'd have to show up at the closing with money. We have people who could afford their mortgages if they had it crammed down and would stay in their property, and the communities would be stabilized, right? Neighborhoods wouldn't be full of empty homes. We have situations where there are people who want to buy homes and they can't buy them because they can't get a short sale, or the appraised value of the house is less than what the amount is owed on the loan.
Just take a second to tell us about short sales.
Oh, sorry. Yeah. So short sales are when, say somebody has a mortgage of $100,000 and the house can only sell for $80,000, where they can go to the bank and say to the bank, look, you take a $20,000 hit, I can sell this house, at least you'll get $80,000. Banks should be all for short sales because the average return on a foreclosure is 50% of the loan amount. So it's kind of a no-brainer, but they're just not, they should have been in place 5 years ago. And that didn't happen. So there are also things called deed in lieu, where the borrower just gives the lender the house and says, here, you can have it. And then the borrower's debt is extinguished. And that they started to do those at the beginning, but then they were giving the borrowers 1099s saying that they had got an extra income that equaled the forgiveness of the debt. So then the borrowers were, these poor folks would get hit with a huge tax bill. But really what I would do, when you think about it, I know what I would do if I was emperor. I would, or queen, I would tie executive compensation to how well banks were providing borrowers with sustainable home loans.
Sounds good.
Yeah.
Tell us just a little bit more about foreclosure, which is this national epidemic. What are the implications of that we may not realize?
Well, in Massachusetts, the implications are huge. Are most of you from Massachusetts? No. Yeah. Okay. So foreclosure is a uniquely state function, but it has tremendous national implications because of securitization. So when you take out a mortgage on your house, you do two things. You sign a note, which is just a contract to repay, and you give the lender the right to come in and take your property if you don't. So the mortgage is the thumb on your property saying, I have control here. And the note is simply a promise to pay. Like any other, like a check is a promise to pay. So traditionally, though the note and the mortgage were both at the bank, right? That's where they were. But because of securitization, that promise to pay got passed on to different entities. Just like when you endorse a check. You write on the back, you give it to somebody, then they can endorse it. You'd have as many endorsements as the check will hold. Well, the same thing happened with the notes. And then the mortgages also have to be transferred, and that's called an assignment. So you have two different things that happen. And historically, those always stayed together. But they got separated with all the securitization. And not only that, the banks, the investment banks, were so furiously getting the money through this pipeline, they completely disregarded the paperwork. So they didn't necessarily endorse the notes. They didn't necessarily put these assignments on the mortgage saying, here, I'm assigning this mortgage now to Walker Todd. So then it came to time to foreclose. And they don't even know where the paper is. I mean, one of the funny things is they sign these affidavits in court saying, oh, we lost the note. But the joke is, you can't lose something you never had, right? And the judges have been saying that. So I'm mentioning this now because in Massachusetts, it's a really huge deal because the state Supreme Court, the Supreme Judicial Court, has said that if you don't have that note, you can't foreclose. you don't have any right to foreclose on the property. I'm sorry, if you don't have the mortgage, if you don't have the assignment of the mortgage, you can't foreclose on that property. So people bought property at foreclosure sales, and they don't own it. But they've taken out a loan on it. They have to pay the loan. And this has just thrown the whole situation, real estate market, into a complete mess in Massachusetts. So that's the Massachusetts story. That's not happening in every state, but in different states, we have different variations on the theme. But more generally, what foreclosure means from a social perspective is we have millions of families that have had to move, millions. Probably will be 10 million by the time we're done. And that means kids who are changing schools, and we know that the rate of teen pregnancy, high school dropout rates, drug use are deeply influenced by changing schools, particularly for teenagers. There's teachers in some of the really hardest hit areas, like in Phoenix, Arizona, and Cleveland, where the superintendents have come in and said, instead of doing a curriculum where you spend a month on Egypt, you're going to have to do a curriculum that's week to week, because you have so many kids moving in and out of the classroom, it's too disruptive to have that. Homeless shelters. And then everything we get from our neighbors, the people who, when somebody gets sick, who bring you dinner, who, if you're elderly, shovel your driveway, whatever, that community is fractured. And for people who sometimes are living on the edge anyway because they have lost their jobs, because they're working class, because they've gotten suddenly sick, those social networks become even more important, so losing them is even more devastating. So that's sort of a social piece, and we're going to feel that as a country.
I want to remind everybody that we're talking to Kathleen C. Engel, professor, and we're talking about the subprime crisis. Let me ask you this, and that is, you're a lawyer, you teach at a law school. What do you have to say about the bar and how it's behaved during all of this?
Yeah. Well, all the lawyers I know are very ethical, and all of our students are extremely ethical. But yeah, I mean, we have these foreclosure law firms that are mills, and when a piece of property goes into foreclosure that has been securitized, the notes are actually owned by a trust. And the trust is a passive entity. It doesn't do anything. It's just in paper. But there's an entity, when the securitization was created, called a servicer. And most of you are paying your mortgages, if you have them, to a servicer. You think you're paying it to your lender, but you're not, unless you're at Berkshire County Savings Credit Union, whatever kind of place. You're paying it to a servicer. That servicer is really, all they've done is signed a contract saying they're going to collect the money from you and send the payments eventually to the investors who bought the bonds that your loan secures. So these servicers, when they have foreclosures, then they contract out a lot of the work to subcontractors, like they'll have title companies, they'll have foreclosure mill law firms. And it's those law firms who were involved in all of this robo-signing, where they were signing affidavits saying, we have the note, we've looked at this property, this person really has defaulted. But all they were doing was getting stacks of, literally, people talk about having thousands of these, and they just signed their name, signed their name, signed their name. There are even cases where somebody was foreclosed upon twice, and all the paperwork was in order because these law firms just were mills doing this. Those really big mills have been shut down, and there are very serious criminal allegations against them.
Who shuts them down?
That's a good question. I think that a lot of them were retained by the servicers who first were the ones who then saw the problems, and then the state authorities came in and brought the criminal charges against them. What I don't know is whether there have been any federal charges against them.
And remind us, what was criminal about their behavior?
Perjury, fraud.
Oh, those little things.
Yeah.
You mean they were swearing that there was...
They were swearing under the pains and penalties of perjury. I have reviewed this loan file, and I have looked at the note, and I see this is what's owed, this is the balance that's due, they haven't made any payments, so on and so forth.
How much do they know that they'd be willing to trade with the DA to open this all up?
Well, this is part of this, what I call the atomization. Everybody's off doing their own little thing in their own cocoon, and it was structured that way to try to insulate the big guys from the wrongdoing by the little guys. So if you pay somebody $2 to mow your lawn, they're going to do a pretty crappy job, right? So it's the same idea. They were pushing this work that should have been done with careful lawyering down onto, low-level folks, and they could then wash their hands. So the servicers can say, we had no idea. This is appalling. We're going to report them to the authorities. And so it's always go down. And that's why you're seeing it's more the little guys who are getting in trouble, right? It's the brokers. It's the appraisers. It's the robo-signers. But somebody's responsible there, right?
I guess. We were just in Ireland. Had a cab driver, said exactly what you're saying about what's going on in Ireland. We all were told, here, take all the money you want, get into it. Our house, we were millionaires for about 2 weeks. So this is now worldwide, isn't it?
There are some countries that were worse than others. Iceland, Ireland. I, of course, want to push my own book, The Subprime Virus, but I have to tell you, Michael Lewis's book, The Boomerang, is fabulous. And he takes 6 different countries and talks about what they did. But there are other countries that aren't facing this crisis at all. Australia, Canada.
And
they aren't.
Because?
They had very strong regulation around the types of mortgage products. And the biggest problems that they had were with Lehman Brothers was one of the biggest culprits, was that the investment banks were going into these little shires in Australia and convincing them that they should invest in these subprime mortgage-backed securities. And so the problem had to do that they got injured as investors but not as consumers.
Kathleen, let me ask you a question. Lehman Brothers, you just mentioned them. Almost everybody was allowed to escape unscathed, but Lehman Brothers got the hammer. Do you know why?
I think the reason that more firms didn't go down is because when Lehman went down, the international repercussions were so extreme that there was a fear that the entire financial sector would collapse, and that the Fed felt like they couldn't afford to do that again, let that happen again.
But do you have any idea why Lehman Brothers was the one that
Because they were first,
uh-huh.
Right? Right? Bear Stearns was after Lehman Brothers.
Interesting. So what do we do now?
I guess I shouldn't say anything very political, but vote for Elizabeth Warren. What do we do now? One is, I think all of us need to recognize that if this housing market doesn't recover, the country's not going to recover. And we need to we all need to personally understand what's going on and be talking to politicians about our desire for them to take a strong stance in coming up with innovative policies. To the extent we can try to get politicians to listen to the view that this problem is not that the effects of the housing crisis are not limited to people who are living on the edge. They affect all of us. I took a $180,000 hit when I moved from Cleveland to Boston because of my house depreciating.
You mentioned Elizabeth Warren. I know to some degree you were kidding, and some degree you weren't. Is there a difference between the way the Democrats and the Republicans look at this problem, or is everybody in the game?
I don't know. I mean, I think that, historically Democrats have been more sympathetic to the common man, and that still is true. But I think they're all taking money from the big banks, and I don't think you can mount a political campaign in this country unless you get a lot of money. If you have millionaires, who's the guy who was the casino guy who just gave like $25 million or so, more than that? Yes, to Romney's campaign, and there are people there on the Democratic side who do the same thing. Until we stop having that system of campaign finance, they're all going to be in the pockets of the bankers. All the politicians will.
So I say this to you very respectfully, and I mean it. When you say we have to learn more, we have to know more, we have to educate ourselves, we have to, insist that there be ramifications for all of this, are we just whistling?
Well, I think it really, I'm talking about, I think that there were some really great things that came out of the Occupy movement. People paid attention. All of a sudden, Occupy is this word. I think we need to...
Was this word,
right. Was this word. Yeah. And, how do we harness that sense of accountability, of holding these institutions and politicians accountable in the way that they did, and that's really the question. In some ways, this comes down to a political organizing question, and I have other ideas too. I have my money in a little local savings bank. I want to really support the smaller banks, but fundamentally, for there to be changes, it's either politicians have to change their mind, or the public has to organize and force them to change their minds.
You said political organization. I just wonder, one of the greatest political organizers we all know is President Obama. Are you satisfied with the way he's acted in all of this?
No. I think that he said all the right things when he was campaigning. And I think he surrounded himself with people who were very tied in with the large banks, Tim Geithner being a big example, and with people who I think made some very big mistakes, like Larry Summers in his position about deregulating credit default swaps, which are the bets that, and it's also going to be used as a hedge, that institutions made where they would bet on how they thought a particular investment was going to perform. And those bets were incredibly risky, and it's a complicated thing, but they aren't traded like through an exchange like stock. And so there was all of this liability flying around all over the place, and nobody knew what it was. They weren't transparent. There wasn't any way to look at it. It was like as if all of us were engaged in a circle of one-off transactions based on one instrument. So you had bets that far exceeded the actual instrument. So just to give you an example, like right now, I think we have $20 trillion in credit default swaps. So these are bets on an instrument, and we only have about $2 trillion of the actual instruments. So there are $20 trillion worth of bets on $2 trillion worth of instruments. So Brooksley Born took a very strong position saying these things need to be regulated. There's all this risk floating around. Larry Summers said, no. She got vilified, kicked off the commission, and so things like that. So he surrounded himself with the wrong people. And then I think he also...
We were talking about Obama.
I'm still talking about Obama. So that was Larry Summers who did it, but he's one of his advisors, close advisors. And I think another problem is that during this whole housing crisis, I think he listened to the academics too much. The economists who said, let's experiment with this. Here's an experiment to try, but you don't experiment in those ways. I mean, you have to innovate, but don't experiment with homeowners, And so they should have been talking to the people who did housing finance. They should have been talking to people who did community development. They should have been going out into the neighborhoods and seeing what was going on. And they weren't doing that. And I think that was a problem. And I think had they been doing that, if they had not been just so pointy-headed about the whole thing, it would have been better.
Okay, so we're going to have a choice in an election not long from now between, Mitt Romney and Barack Obama. And based on what you've just said, Is the situation fairly hopeless?
No, I think that Barack Obama is going to take a much stronger stance if he's reelected. I think this is true of every president who makes it to the second term. The first term is all about making sure you can get reelected, and the second term, you kind of put your pedal to the metal.
And what about Congress? If Obama doesn't bring a Congress with him in this election, it could be more of the same.
That's true. That's true. I am a very hopeful person, but I can certainly feel hopeless when people ask me questions like that.
Well, if you had to go back to the beginning, Professor, and decide whether this was a good area of investigation, do you feel that it's so frustrating that maybe you might have picked on something else, like the Easter Bunny or something like that?
No, I'm really happy. I felt I will continue to do this work. What's funny is that it started as a 2-person reading group over a summer. Let's try to figure this out, and we're still writing together and having fun to the extent you have fun looking at sad, tragic situations, but trying to understand it, trying to make it accessible to people. Both Pat McCoy, one of my co-authors, and I have been very involved in a number of policy initiatives that have borne fruit. So I feel like, coming from a background as a civil rights lawyer, I didn't want to just be an academic writing articles. I also wanted to try to continue to make change and help influence policy. So
well, I don't know about anybody else, but I'm going to go out and buy the Subprime Virus, Reckless Credit, Regulatory Failure, and the Next Steps. And I just want to thank you so much for spending all of this time with us. You're wonderful. Thanks very much.
Thank you. This is really fun.
Okay, do you want to?
Question. I'm sure the audience would like to ask questions.
Sure.
I assume that's fair game. But do you need to kill your side of the broadcast, or are you going to?
No, we're done.
Yep. Audience.
Yes.
I have 2 questions, actually. The first one is just a very short sort of statistical question, which is, of the total body of subprime loans that were written, how were those ultimately allocated in terms of retained by individual banks versus processed by government agencies like Fannie Mae, Freddie Mac, versus being securitized by Wall Street?
So
Clarify that from, it was different at the beginning versus the middle and the end,
Yeah.
that percentage.
Yep. So I don't think any of them, I'm not aware of any institutions that were holding significant numbers of subprime loans. They were all securitized, I think. There may have been a few exceptions. So, yeah. So when I was describing securitization is also done by Fannie Mae and Freddie Mac. And they do the same thing that Wall Street does. They take the pools of loans, they carve them into securities, they sell the bonds, and people purchase them. During the 90s and early 2000s, Fannie Mae and Freddie Mac had the strongest anti-predatory lending rules anywhere in the country, even stronger than North Carolina's, which was at the vanguard. So, and they were very, very careful. And they screened loans and they rejected loans from their pools if they met any of their, if they were kicked out by their electronic systems that screened for them. And they also had provisions that said that if some loan did slip through, that did have a predatory lending feature, that the originator of the loan, the lender, was required to buy it back. So it would be kicked out of Fannie's and Freddie's pool and returned to the originator. But the really risky stuff and the subprime stuff was happening, was being sold on Wall Street. But what ended up happening is that Fannie Mae and Freddie Mac started to really lose market share, and one of the things that was happening with the loans that were going into the securitization pipeline on Wall Street is that the loans were being written in ways that were designed to evade some of the anti-predatory lending laws. So they would have these things like pay option arms, where every month you could choose, you could either pay the full principal and interest, which is what you usually pay, just the interest, or less than just the interest, and then your principal increased every month. And there were all these different funky products coming out, and what would happen is that borrowers would go in to get a loan, and the broker would say to them, look, this is what your monthly payment would be with this loan that could get sold on Wall Street. And this is what it would be with the Fannie Mae conforming loan. And the monthly payment would actually be higher on the Fannie Mae loan, but long term the borrower would pay less on the Fannie Mae loan. Because ultimately, all the money they weren't paying up front on the Wall Street securitized loan they were going to get the money somewhere. It wasn't like a free lunch. So Fannie Mae then started to relax their underwriting standards. So they started to also get into that risky territory.
Total fraction that were written over the entire period before the crash, what would be the distribution between Wall Street and Fannie?
Yeah, I don't know. I don't think I've seen a number on that. I mean, definitely Fannie and Freddie is a very small portion.
Let me jump in with my
Yeah.
my main issue here. You presented a certain model of what happened, which I've been trying to get a handle on this lately, and what you're describing seems to be very incomplete and distorted. Let me tell you how I've come to tentatively understand it, and then I'd be interested in the response. First there's been what you alluded to, but didn't place that much weight on, for a period of, I think, at least 20 years, a sustained government effort to force on the banks to, in the name of expanded home ownership and affordable housing, rules that actually required banks to make loans they wouldn't normally have made. So this has been going on, and that's been growing and had been growing in intensity for over a period of 2 decades, I believe. That's pretty well documented in Thomas Sowell's Housing Boom and Bust. Then simultaneous with that, you have a massive monetary expansion by the Federal Reserve, extremely low interest rates, which is basically supplying the entire fuel for this entire process. And you didn't touch on that at all. Whereas, from my perspective, that may well be the underlying issue here of the entire system. And you're focusing very much from a very liberal, left liberal perspective, that the problem here is really a failure of regulation of the evil capitalists on Wall Street. When in fact, really what seems to have happened is that they came on at a third level above the massive monetary expansion leading to bubbles, first on Wall Street at NASDAQ, then a reinflation following the collapse of that bubble with an inflation of the real estate bubble. All that was built on top of a regulatory regime which you yourself seem to have supported in favor of forcing the banks to make loans they wouldn't normally have made. And then Wall Street came in and securitized things, and now they're taking all the blame, and the issues being laid on capitalism as if we need more regulation. So I'm interested in how you would.
Okay, that's a fair question.
Okay, but I have a good answer.
Of course, yeah.
Yes. So first of all, it's very difficult to force a bank to do anything, right? I mean, we want the banks to loan money right now, and they're refusing to loan money. I take issue with that.
Wait,
I think
you ask the question, she gets to answer it.
But I think what and secondly, I can't cover everything, in this talk, but I encourage you to read my book because I address both those points in almost a full chapter on them. So I'm not afraid of dealing with these issues. And the third thing, before I get to it substantively, is I don't think anybody's innocent here, right? I will tell you, there were investors who were taking advantage of these deals and ripping off the federal government and lenders. There are borrowers who knew full well that they shouldn't be buying what they were buying, and they were full of hubris and greed and did it. Nobody is spared in my viewpoint, including myself, right? I was making money. My pension funds or 401ks were doing really well with their RMBS, their residential mortgage-backed securities. I knew what this was about. I should have been saying, I'm not gonna invest in this. So no, Republicans, Democrats, Libertarians, Green Party, we all play a role. But in terms of I want to talk about CRA because I think that's what you're getting at here, and that is there are some people. I'm going to explain what it is. Okay, so there are some people who take very dogmatic positions around issues like the Community Reinvestment Act, which is a CRA, and don't rely on the data. So the Community Reinvestment Act is a law that says that if banks take deposits from consumers in a neighborhood, they have to also lend money there. And the reason why was that we found out that banks were taking deposits from poor people and then lending their money in the suburbs to wealthy people. And so the federal government said, if you're going to do that, you can do that if you want. But if you want to get bigger, you have to do a better job serving the people in the community. So that's what happened. So if a bank wants to take all the deposits from poor people and loan to rich people, that's perfectly fine. But if they want to acquire another bank, they can't be engaged in that kind of behavior. And they get a report card, and it's called their CRA rating. And by the way, I think it's 5 banks a year don't get an acceptable rating. So almost all of them do. It's not like it's so hard to get. And the way they can get a good CRA rating is they can make loans to be able to build a supermarket. They can fund financial literacy programs in a high school. They can, there are different tests. There's an investment test, and I can't remember them all now, but they're different tests. And it's very fluid. The banks get a huge amount of control about how they're going to implement these tests. So one of the concerns was, well, maybe because of CRA, banks were making loans that were not affordable and then therefore responsible. So I was actually at a meeting where the Federal Reserve Board of Governors convened all the major banks in the United States and asked them that question. And you know what the bankers said? If we were going to make loans where we lose money, we would lose our jobs. Our shareholders would vote us out. We make money on CRA lending. We have to work a little harder to make the money. We have to spend more time on the underwriting because, you know, it's a more complicated situation than the affluent person with a lot of assets. So that's the first thing. The second thing is the Federal Reserve Board, because they can get data that none of the rest of us can get, got the data on CRA lending in all the banks in the entire United States, and they looked at the default rates of the loans that were made to satisfy the CRA, and the default rates were 1/3 the rates of subprime loans. So I don't know the Solo book, I haven't read it, but I can tell you that argument is basically in the trash. It lasted for about a year. And then once the data came out there, and nobody has yet been able to produce any data, it's just theory, that the CRA was responsible.
Alan, do you want to respond to that?
No, I just want to make sure everybody gets a chance. Yes, sir.
Yes, there are proposals now to have a rotating allocation of bond investing to rating agencies so that they will not be beholden to the investment bankers. Do you see this as a possible solution to avoiding the next problem?
Yeah, I think that I like that proposal. I think another thing that we need to do is we need to allow more rating agencies, because one of the things that happens with bond ratings is oftentimes the investors are going to want ratings for 2 or 3, right? So the rotating doesn't solve the problem because we really only have 3 in the United States right now, although there's a new one that was recently approved. So, and what's happened is it's very hard for new entrants to come into the market for a couple of reasons. One, why would I go to a new entrant who has no reputation in making a decision whether to invest? So that's one piece. And 2, the SEC is the one who decides whether a new entrant can come in, and they've been really bad at doing that. Now there is Jules Kroll, the big financial detective. He's starting a rating agency. So hopefully if we can really come up with ways to facilitate new entrants, then they'll be competitive based on the reliability of their information. But up until now, it's like an underwriter's laboratory. They just put their seal on it, and that's it. So yeah, I think we need to think hard about that. Not only because of these investments, but also because when the regulators are assessing the safety and soundness of banks, they rely on the assets, the quality of the assets in the banks. And how do they know the quality of the assets? They're relying on the rating agencies. So we either need to stop doing that and come up with a different system, or we have to really improve the system, because it exposes all of us to the possibility of systemic risk, failure of big banks, if those ratings aren't accurate.
Yes.
In subprime, and then of course, but wasn't it all based on the fact that this time was different? Housing prices and values would always steadily increase. And in addition to subprime, there were no interest loans to folks who had the money, but home equity loans to folks who used the houses as piggy banks because they'll always reclaim it when they sell it. Yet I have friends, this is my question, I have friends who live in Pittsburgh, and they say, what bust? What boom? We didn't have a boom, so we didn't have a bust. Of course, they were impacted negatively by the recession and the depression that resulted from all of this. But can you give any credibility to the fact that, well, we know places like Florida and Arizona and Nevada went overboard. Were there pockets of places in the United States that didn't experience a housing bust?
That didn't experience a bust? Well, probably Palo Alto, California. Yeah, maybe. I don't know, Greenwich, Connecticut. Indiana, though, was really hit hard with predatory lending, though. I mean, they were Indiana, Illinois, Michigan, Ohio. The Midwestern states were the first hit. Then it was only later that the Sun states got hit, and the Central Valley of California got hit pretty early. Western Pennsylvania got hit very early, but. I mean, west of there, yeah. Well, actually, Pittsburgh didn't have the boom. What happened? Right.
Didn't have a boom. We never had a bust.
Right. Pittsburgh
didn't fall for this thing. Steadily increasing values, use your house as a piggy bank, and all that.
Yeah. I don't know.
Okay. We're sort of running out of time. Anybody else? Yes.
So if Timothy Geithner has a strong background in Wall Street activity, and he's in the cabinet, and the chief prosecuting officer would be Eric Holder, and he's in the cabinet, what opportunity is there for anything substantive to happen at the federal level?
Well, the good news is that Holder isn't put out in front when there are prosecutions like this, right? But yeah, that happens. But it's why we have things like the IG, the Inspector General, who make sure that the Department of Justice is doing what they're supposed to be doing and not nixing investigations for political reasons. But I don't know that that's I don't think that's a new problem, but I think it's a problem.
Professor. Oh, yes. Go ahead.
Having improved regulation to prevent these things from happening again and holding people accountable would be good things. And Elizabeth Warren talked about that. But you said, I thought it was really good, that a lot of people are affected by it who were not involved in predatory loans because they lost home equity in their homes, and they're not able to get refinancing now to take advantage of the lower interest rates. And I'm worried about the political reaction of those people who, you hear it again and again, feel that the big guys got bailed out. People who were victims of predatory loans are getting help, but I'm here and I've lost the capacity to do so many things in my life. And I'm worried about where they're going politically. So is there a positive program that Elizabeth Warren or others could offer that would meet that problem?
Well, I think that we should cram down loans of people even who aren't in default.
What do you mean by
Reduce the principal. Reduce the principal, and you can do things like we need to start with first principles. That's what I keep going back to. So one is, we don't want to reward borrowers who engaged in fraud, right? And we do want to recognize that people are in over their heads or own property where, it's a net loss to them to continue to own it. And we also want to recognize that when people sell their homes or walk away from their homes, that it has systemic effects within a community, right? And we also want to recognize that even though we may feel like the lenders or the investors ultimately should take haircuts here because of there were excess profits made somewhere along the way, we have to take all of these things into account in crafting a solution. So if I were doing, what I would say is, let's cram down everybody's loans to 95, who are underwater, to 95% of the value of the house. Because we want them to have some equity so they'll have an incentive to maintain it. And then give whoever owns the first mortgage a second mortgage that the borrower doesn't have to repay until they sell the house. And at that time, whatever appreciation the house has gained, they share 50-50 with that first mortgage. So what does that mean? That means the lender is getting something, right? Because if the borrower walked away, they're stuck with a piece of property. So that somebody's living in the house who wants to live in the house, who can afford to make the payments. And when there's appreciation, they're going to get half of it. So it's deferred. And for the borrower still has an incentive to maintain the house and an incentive for the house to continue to increase in value. And the neighborhood is stable. That's how I think we should be thinking about policies. And I know there's a lot of fine-tuning you'd have to do with this, right? If they put in a new kitchen, right, they've suddenly increased the value of the house. Does the lender get 50% of that? But that can be done, right? But I think that what we need to do is step back and say, okay, what are we trying to achieve? How are we going to set up the rewards in the system? And your other point is, I also worry about the people who, they aren't underwater. I'm not underwater, but I'm paying for this, right? I've paid for the banks to be bailed out. I have paid for HAMP and HARP and all these different programs in different ways. And if there's a huge federal program, all these stimulus packages, I'm a highly taxed person, I'm going to be paying for it in my taxes. And I think that's, a political problem too. So it's not just the underwater people, it's other people too. And all of us who didn't get into one of these loans, right?
Yeah.
So I know you said you have a chapter about this in the book, but maybe you can just give us a short answer. My understanding is that as of 2008, Fannie Mae and Freddie Mac together owned roughly 50% of all the residential mortgages in the United States. So through them, if you think of the U.S. government, through them, was the biggest underwriter of residential mortgages in the history of the world.
Yeah.
I mean, that had to have had a big effect, right?
Well, Fannie Mae and Freddie Mac have been the primary purchasers of prime loans for decades. The difference is what happened with the subprime loan. So there's nothing new about that, about the roles of Fannie and Freddie. All what are called conforming loans are Fannie and Freddie loans. People think that they have a loan with Wells Fargo or whatever, but Wells Fargo sold that loan to Fannie Mae, and Wells Fargo is simply the servicer who collects the money.
So, do you think that helped fuel the bubble, or do you think it was just the subprimes that are the only thing that matter?
I think that just the huge expansion in credit, I think there are a lot of things. The low interest rates, I think, were a problem too, although I think they were only one of the problems. I think a second thing was this was our second subprime crisis. Before this, we had another one. Some people may remember the money store in Conseco. Those were and the manufactured home defaults, and we didn't learn anything from that. How about long-term capital management, right? What did we learn from that? So we're slow learners. I mean, the part of what makes, I think, this country great is our ability to deny. I mean, it's true. We forget, and we charge forth. I may have had cancer, but I'm cured now, and I'm going. Whatever it may be. So I think that's a problem. And I also think just after 9/11, if you look at the rhetoric after 9/11, which was very bad timing, right? Because it was right after the dot-com bust. So the stock market had the October 19th crash, right? We had 9/11, a year later. I think it was just a year later. We were fragile economically. Look at the rhetoric from that time. There's actually a quote from George Bush where he says, "Take out your credit cards, spend money the way you as consumers can get us out of this." And he was right. We spent our way out of that crisis, and I don't think that was a bad thing. But during good times, you have to exercise restraint. And during hard times, you have to spend. We need counter-cyclical economic policy. And what happened is, when times started to get better, what did we do? We pushed out more credit, more credit, more credit. That was the time to save, for states to boost their balance sheets, whatever, and all that kind of stuff. So this is so complicated to understand that you can't just look at just one thing. So all of it was of a piece, but the pushing of credit and the pushing, it was both a demand side and a supply side phenomenon. People were demanding credit, right? But also it was being pushed on people. Think about how many credit card applications you were getting. The investment banks were actually placing orders. They would not just buy whole loans that had been made. They would go to lenders and say, I need $20 million of no documentation loans. The reason they wanted no documentation loans, that's why we had all these no-doc loans, was that there are these entities that screen every loan to make sure that the loans comport with the lender's underwriting standards. So a lender says, these are what our underwriting standards are. We don't make loans to people who have credit scores under 600, things like that. And so then the due diligence companies, like Clayton Holdings is a big one, they look at all of the loans and make sure they meet those underwriting requirements. Really good thing, right? Well, so what's the way to avoid that? Have a loan that doesn't require any documentation. So they described themselves as potted plants. They would get the loans. It would say the underwriting requirements are that we don't need any documentation. Okay, it doesn't have any documentation. All set, and it goes. That was being pushed out by the investment banks. It was not the lenders who said we want no-doc loans. The investment banks were saying we want no-doc loans. And they were placing the order. So that's what I mean by it was both a demand side and a supply side phenomenon.
Thank you very much. Appreciate it.
Thank you.